The Wall Street Journal's John Hilsenrath joining us now, and Macro Allocation founder Paul Brodsky with us this morning. Gentlemen, good to see you. Thanks so much for joining us.
Great to be here.
Thanks a lot.
One thing that Neel Kashkari didn't say as another reason that the country got through all the mess back in 2008 was because J.P. Morgan acquired Bear Stearns and Washington Mutual because of its size and its strength, John Hilsenrath. That's why they were able to make those acquisitions and help the country.
Maria, I think that's exactly the point that I was going to make. You know, I've been a little puzzled for the last 6 years about all this debate about ending too big to fail, because if you look at what actually happened in the crisis, the biggest banks actually helped to prop the financial system up. It wasn't just J.P. Morgan. Let's not forget that Bank of America, after Lehman Brothers collapsed, bought Merrill Lynch and basically rescued Merrill Lynch from collapsing. Wells Fargo was a very strong bank. You know, if you look at where the problems were in the financial system, it was AIG, it was Bear Stearns, it was Lehman Brothers, it was the Reserve Fund, a money market fund. None of these were the big banks. It was other parts of the system that were really struggling.
I said all of this yesterday to Neel Kashkari, John, and he basically just pushed back and said that the banks are too big to fail. But the fact is, we want somebody like J.P. Morgan, as strong and big as it is, to be able to step in when the country needs it. I think, I don't know about you, Paul, in terms of this too big to fail story, but for me, I think it's all politics, and it just plays well to the populace, but it has no reality in terms of happening, in terms of breaking up these banks.
Well, I think there's a lot of politics involved in most all we see on Wall Street, including the size of banks and too big to fail. I think it's a little more complicated. I won't take the other side completely, but I think what we're seeing play out in politics as well as on Wall Street shows that the popular sentiment is to break up the banks, and there has to be a voice for that. I think Neel Kashkari is taking that voice.
Well, I'm curious to hear from you, though, John. What do the other members of the FOMC and the other Federal Reserve presidents think of Kashkari? He hadn't been there long, and he comes out and with this kind of very bold idea.
Yeah, what did Dan Tarullo say about it?
Well, not just Dan Tarullo, but Janet Yellen. You know, Janet Yellen was up on Capitol Hill last week, and she was asked if the Dodd-Frank law was working, and she said, yes, it is. And then Kashkari comes and says, no, it isn't. You know, I think it's interesting because the regional Fed bank presidents have less power today than they did 8 years ago to do anything about the banks. Dan Tarullo, who you mentioned, who's the Fed governor who runs supervision, has concentrated all this power in Washington, so he's the guy calling the shots. I think he probably doesn't feel that threatened by Kashkari. I'll tell you the one other thing that Kashkari said, which he said to us, which is an interesting part of this debate, is that he thinks that the big banks should be required to hold even more capital. He was talking about 25% capital. Now, the Fed board doesn't want to go there, but I think there is a very big push here in Washington to get even more capital in these guys.
Yeah, well, we'll see what that does to the economy as well. Meanwhile, CME Group President Terry Duffy and billionaire real estate titan Sam Zell shared their thoughts on the Federal Reserve and any future interest rate hikes yesterday as well. Listen to this.
Clearly, I think the Fed waited too long. I think the raise that they made looked like an afterthought and looked like a response to pressure from the street as opposed to an appropriate and measured pace. It's hard for me to imagine, based on what I see today, that we're going to see interest rates going up.
They want to take rates down to zero or negative interest rates, force people to spend money that they don't have. We have $8.6 trillion in mortgage debt. We have $1.3 trillion in student loan debt. We got $1.2 trillion in credit card debt. So you got $11 trillion just with the consumer in the United States on those three items alone, and we're going to push the consumer, the saver, to spend money when they don't even have it.
So there you go. Meanwhile, Anastasia, there are now lowered expectations that we actually will see more interest rate hikes this year.
They have. I mean, I think the Fed is quite concerned about the impact that the financial markets can have on the economy. They may not be admitting it right away, but we know there's some channels through which the wealth effect or the confidence effect could eventually touch the economy. One thing that the minutes really focused on is that the labor market is strong. That's true, but the labor market is a lagging indicator. Credit creation is a forward-looking indicator, and credit conditions could also be a forward-looking indicator.
Does this dictate how you allocate capital schedule right now, Paul?
It does. As a matter of fact, we're taking the other side of this. We think the Fed will actually hike rates
when?
Sometime this year.
March?
Probably not March, but we think...
But not 4 times.
Probably not 4 times. I think what the Fed is trying to do, and we're a bit out on a limb with this, is to keep the dollar strong. And in a world of contracting global growth, we think having a strong dollar is beneficial to the U.S. Unfortunately, the U.S. Treasury does not seem to be enforcing dollar policy.
Let me just follow up on that. Keeping the dollar strong, I mean, hasn't that been the biggest headwind to U.S. equities? Hasn't that been the biggest headwind to exports? Why would we want the strong dollar?
Earnings are down 4% last quarter, year over year, because of the dollar.
Absolutely, but this is not a U.S. equity market thing. I think what the Fed is looking at is something a bit broader than that. We don't see Treasury now, like when Bob Rubin was running it, enforcing dollar policy. Zero rates, QE. We have a new world, and so central bank monetary authorities have to enforce dollar policy. So I think in a world of declining rates or declining global growth, my sense is that the Fed is trying to keep the dollar strong, talking up the dollar by hiking rates when everyone else is cutting.
Keeping capital flowing into the country, keeping our banks safe.
That's it.
John, how does that sound to you?
Well, I mean, I think the Fed is a little concerned about the effects of a strong dollar on growth right now. And also, let's not forget, the strong dollar puts downward pressure on inflation, and they're trying to get inflation up to 2%. I do think, though, that Paul points to something that people need to get their heads around, which is that, you know, there's been a lot of talk about negative interest rates and the Fed isn't raising rates again. They're still of the mindset that they're going to raise rates, but what I'm hearing from people, especially over the last few days, is let's take this slow, you know, let's delay, you know, don't do March and see if the forecast plays out for the rest of the year. Their forecast goes like this. They think that once oil prices stabilize, we're going to see inflation lifting a little bit. They think the job market's going to keep improving and growth is going to get back on its feet. You know, I talked to Pat Harker, the head of the Philadelphia Fed, on Tuesday, and his argument was, let's wait. Maybe by the second half of the year, we could get some more rate increases in. I think that's what the market is starting to look at. You know, the first half of the year is looking increasingly remote for rate increases, but we might see 1 or 2 more by the end of the year if the economy holds up. And there's some good reason to think that the economy is going to hold up. The data haven't been all that bad.
Yeah. Markets, real quick, Paul, you think we'll see more volatility in terms of markets? Do you believe in this 4-day rally that we're seeing? I'm still a bit cautious. I think you're not supposed to aggressively sell it. I think you're not supposed to aggressively buy it. And we're going to see a lot more volatility. Paul Brodsky, good to have you on the show. John Hilsenrath, thank you. We'll see you soon, sir. Big